partner with Axon, you immediately gain access to a full range of products and solutions designed to meet the complex needs of today's grower. We carry all major brands and sizes of tires and wheels. We specialize in large diameter wheels for large equipment. We have one of the largest OEM replacement wheel inventories in North America. Known for extreme flotation setups, duals, and triples, we have wheels for all makes and models of tractors, sprayers, combines, and grain carts. If we don't have the wheel in stock, we'll custom build, sandblast, and paint in-house. There isn't a more vast inventory in North America dedicated to helping dealers move more iron. With facilities on the West Coast and in the heart of the Midwest, leverage our 230,000 square feet of indoor inventory to solve any problem a grower may have. Move more iron with Axon.
Moving iron.
Hello and welcome to Moving Iron Podcast number 336. This edition of Moving Iron Podcast is brought to you by Axon Tire, helping dealers move more iron for the past 100 years. For more information, go to axontire.com. Axon Tire has got two great gifts I'd like to give away to the Moving Iron Podcast listeners. One is an Alliance branded flashlight and an Alliance ball cap. So if you want one of those, send either of those. Send an email to marketing@axontire.com and they will make sure to send that to you in the mail. So you get a free flashlight and a free hat over at marketing@axontire.com, and I'll get that over to you. They're also paying for the first $50 of your registration fee to the Moving Iron Summit coming up here in Nashville, Tennessee, September 11th through the 13th. So if you're interested in doing that, go to Moving Iron LLC and fill out the form under the Moving Iron Summit registration tab. Check that out. Valley Transportation has been hauling ag and construction equipment across the country for the past 33 years. Call Parker at 800-657-4910 for all your trucking needs at Valley Transportation. Our goal is to help you reach yours. And no matter how you buy your ag equipment, whether it's from a dealer, an auction, or a private party, AgDirect can help you finance it. You can even apply online at agdirect.com. Learn more about your financing options at agdirect.com. Tractor Zoom has access to over $20 billion in heavy equipment sales data. Tractor Zoom's Iron Comps is the industry's trusted solution for transparent equipment values and auctionable pricing insights. This podcast is also brought to you by Anvil AppWorks. The Dealer Connect CRMI app with integrated inventory management is an affordable Salesforce-based solution for your dealership. Create connected customer experience and transform how you work today. You also can count on the folks over at Iron Solutions, powered by Randall Riley, to help bring this podcast to you as well. I have Rich Posson back on here to talk about what's going on in the overall marketplace. And Rich, there's quite a bit of stuff going on there right now with what we see happening with Chairman Powell giving his testimony up there on Capitol Hill over the last couple of days. What he's talking about now, this is the first time I've really heard him stick to his guns and say, hey, we are going down this path. This is what's going to happen. We were doing 0.25% stuff. We maybe do more, maybe do less, but we are absolutely staying with the course that we're on. We have to. There's a lot of stuff going on there. So I guess as you listen to his testimony, Rich, what are your thoughts there? And I guess, how is your model reacting to what you see happen?
Yeah, so I think Paul is, just reiterating what they started with for a while, and he kind of backed off in the last rate hike there, saying, hey, we're making gains here and things are probably okay. And then the guy goes back in to speak to Congress and wait a minute. But, I think if we could talk to him personally, he'd say, we're going to get bumps in the road and we're just going to have to deal with them along the way. I question if he's that aggressive this time around with the higher interest rates, but I do believe they're going to put rates higher into June, July, and they'll skip April, but early May, they'll probably raise them, probably June and July, they'll raise them. I think they're saying, you know what, one way or the other, we got to stick with what we originally thought. We got to get rates higher than the inflation rate. And so that's what they call the terminal rate. And the way inflation's dropping in the private calculations of people, we could get there quite easily by June. If you look at the government's rate. They've changed the formula that held it up. It's just weird. It's kind of like, it reminds you of people complaining about USD and the grain markets that they never had the number right. And it just feels like, the government is showing us too high a number of inflation. And it's like, they just did something to keep it even higher. So it's weird, but it is, at least the government number is trending lower. And I think next Tuesday, we're going to get a CPI report. And unfortunately, it looks like most of the professionals out there are saying it's just going to come down a little bit. That may bother the markets here a little bit, that we're just not moving fast enough. But at the same time, I think most of the marketplace understands that. They already know that even I could see in February, it doesn't look like it was slipping that much. And for some reason, right after the first year, people just bought like crazy, and they bought all the way through January, somewhat in February. In fact, for some items, they bought more in February than January. And it's just kind of bolstering, holding up, supporting this inflation to drop as fast as it once was. But again, some of these private numbers in just last week show it's now speeding down again. But those numbers can be off the mark. It could be a huge lag compared to government. We might be stuck here for a few months that it's just coming down too slow, and the Fed will continue to raise. I'm not concerned. The modeling is saying the Fed can take this all the way to 6%. It's not going to kill the economy. I don't think you're going to kill the economy to get above 7 and maybe even as high as 10%, but it also depends how fast you raise it and how quickly do people respond and get scared. So I know a lot of people are scared of 6%, but hey, they were scared of 5 and now they're okay with 5. So they're scared of 6. So I think they're going to learn to be okay with 6. I think somewheres in that 5% area, possibly touching 6 is going to be the highest this year for the Fed. They level off for the rest of the year. And then next year, they actually lower a little bit. I think the free market interest rates, if they haven't already topped for the longer term rates, like the 30-year and the 10-year, they'll top soon and they'll ease back into next year. So in other words, they'll start down before the Fed, and in a way they already have. The 90-day and the 2-year rates, the shorter term side of the curve, has rebounded to new highs compared to last year. That's understandable. They're so short term, they have to be in line with the Fed. So they'll stay up perhaps all the way into June, even if the farther out rates start down any day now. But it just looks farther out, we're going to be okay. And the model's still saying be bullish the stock market. It might be more of a struggle than we want, might be a slower paced yield. And keep in mind, stock market's up 14% from last year's low, and it did it in just 4 to 5 months. So that's a pretty darn good return.
Right.
We shouldn't be surprised it has to stall out at times and moves at a slower pace, and therefore we shouldn't be surprised there'll be some news related to that, some reporting that just concerns investors how bullish they really want to be. But I think in terms of Powell, yeah, I think they're going to raise them. I don't know how to bet on what's going to happen. March 22nd, I think, is the day the Fed raises. Is it going to be a quarter point, a half? The marketplace seems to be betting it'll be a half. I don't care. What the model's saying, if it's a half, that might knock the market down a few days to a week and a half, and then it's just going up anyways, because what will happen is investors will flip and say, well, longer term, this is a good thing. We're gonna fix this problem, okay? Shorter term, it'll be discouraging they had to do it. So it's just all this data, you can just see it's like short-term problems, long-term okay. And it just causes friction, causes problems getting traction. We get stuck in the mud here in the stock market and some of these other markets here. But so yes, I think the Fed continues to raise, and I'm just hopeful by June, and I think it will happen by June, we're actually going to see the Fed's rate slightly higher than CPI inflation. And then I think the Fed will say, now we can be even more patient unless inflation jumps on us. And as soon as it jumps, well, they're going to have to start over and take it higher still. So I kind of hope people can behave themselves and businesses don't ask for higher and higher prices, and people kind of hold off on their buying a little bit. And we did see a good surge of consumer buying. And we need to discuss the consumer. What is the consumer doing? Because there's conflicting data there as well. Some are saying, oh, the consumer's all tapped out. He's already got problems. He can't pay his credit card bill. He can't pay his auto loan. But I've seen this data before, and it really didn't matter. And I don't think it's going to matter right now. And the weird thing is we have other data on the credit cards and their overall finances for their households. They're still sitting on money from a few years ago they saved. They still have money. So some of this negative data just does not add up of where we're going to have a huge down move in the stock market. We're going to slide into recession. It just does not add up. But at the same time, it is like a thorn in our side. It's just, we're moving forward, but gee, we got a little pain along the way here and some frustration. So yeah, I assume the Fed's going higher, but I don't think it's going to cause crashing market, huge down move. It'll cause short-term down moves, and then it comes back here. I am picking up signs that people are buying stocks and accumulating stocks here, but the point is they buy for a week. Well, then if they don't need to buy, it really takes only just a few sellers and knock the market right back down again. And it's just this ratchet process, and eventually we'll get enough. Anybody asking for clues? Is the market really going up? Well, if we can get the S&P 500 above 4,200, that'll look good. But my best evidence we're in a long-term bull market, just you're looking at prices, nothing else, get it above 43.25, the August high.
So Rich, there's a lot of stories I hear right now that guys are, especially this morning, I've seen them more this morning than I have any other time, but I'm talking about, the S&P could fall by 500. You're talking about, or by 500, S&P 500 could fall by 20% by sometime midway through this year. You're talking about some other people out there that are talking about, the whole stock market as a whole could crash by 30% in the next 60 days. We are, I like what you just said, there's data out there that shows that people have the cash and capital, but there are also, a lot of different debts and stuff out there that people are working through. What's your reaction to those kind of headlines and those kind of stories out there right now?
Yeah, I see some of the data they're looking at. Some of it's actually pretty good analysis. Some of these people have good track records. But the interesting thing is when you overlay these business cycles and then compare to prior generations who made the same calls and going back 100 years, you find they can become overly bearish during the boom phase. And really, history teaches that last year, the stock market had dropped as much as 25% at one time. That's about the maximum the stock market drops. It's only dropped twice in 100 years of 30 to 35%, and that was the maximum. So we really overdid it. So it's very unlikely those types of analysis will be correct, at least this year and next. Now, a little later, they may have another opportunity there. And then still later in the decade, they'll probably be wrong. And for these people who are looking for huge moves down, like 40 or 50% down, it's always occurred when the major decade-long business cycle turned into a recession, and that's not due to near the end of the decade. So I realize there's always a chance to get new history, something that you just can't explain, and something broke. But right at the moment, believe it or not, even though a lot of this data and this news over this inflation is new to us, especially the younger generations who didn't grow up in the 70s with inflation, the market is saying we've seen this before, and it's actually behaving normally. So within the position of the business cycle, we've already seen the pullback we should have got. So those people are still holding out for yet another move lower. They're less than 10% probability of being right, in my opinion. And yes, I can be wrong, but I look at my track record and using this for 40 years now, and I look at what I've done, which really, when I look at my own money, you have to be careful. There's analysis, and then what did you do with that analysis? And sometimes I don't even keep up with my own model. I could have done better last year compared to what my model did. But I've beaten the market since 2010. And I must fit in like the 25% group to do that. Again, that may have a little something to do with me, but the way I look at it, it really does reflect these business cycles working. And it just gives me confidence to say, I think the other guys are going to be wrong. Now, what would scare me that something is going wrong for me and my model? Probably trading below the December low, and I can't think of what that price level was. Go below that, people are going to get nervous. It's going to go back to the October low, which was the lowest price last year. And I believe that lowest price, is a type of long-term bottom that's suggesting higher stock market in 2024. And the GDP right now is 2.6%. The model's saying it's going to 3 to 4% in the next 2 years. It's highly confident. Even if inflation stayed high, it would actually help get that GDP that high. But we don't need that, okay? Inflation can go down and the GDP can go that high anyways. That kind of gives me some confidence. Last week for my subscribers, I made a call for a minor long-term bottom in the PMI indicators. That is very risky. The indicator, when they released it last week, it only ticked up slightly. You can barely see it. But it's getting so late, it's time to bottom. If we can get that PMI moving up this year, that will connect with the GDP, which is already heading up. And it just gives us more evidence that probably the economy is going to grow, and in a good way. Okay. The economy has been growing all along through all this problem, but it's not the best way. It's kind of growing too fast in some areas. And that's why we're fighting. That's why we're seeing inflation. And that's why we're fighting inflation here. So, yeah, I have to discount those people and say it's their turn to be wrong, and we'll go from there.
Right on. Okay, so let's talk about the dollar a little bit. Dollar has still been doing quite well comparatively to the rest of the world. We've seen it spiking this morning. It's getting jumping up there. You'd mentioned something about how Japan printing money and China printing money, those are 1 and 2 as far as what really reflects back onto the US dollar and where we're at there. But talk about that a little bit and explain why those 2 factors really work against the US dollar so well.
Yeah, there's going to be more discussion of this because I think half of the professional Wall Street hasn't even thought of this. And there's some very interesting people are coming out with some interesting ideas of this. The Bank of Japan has been printing for a while and printing money heavily. And they really have not, their inflation is fine. It did not explode off the printing money like our country did. And so they're still printing. Now, what might be a risk of that is the person who's the head of the central bank there in Bank of Japan has been there, seems like forever. And he, it may be time for him to retire. Somebody shoves him out or he just wants to quit or whatever. And some people saying you might bring in somebody else in, it won't do that. And that could suddenly flip some switches here, how things are working. But how it's working at this moment is, yes, they're printing money to help their own economy, but that money is also being reinvested around the world and it's creating better liquidity globally. And some of that, I believe, is in the European stocks. And I correctly called the bottom in European stocks a while ago, and they've been doing better than the US stock market. France is already at record highs in their stock index. Germany is near record highs, whereas we're still off our record highs quite a bit. So Europe has had a good run, even with the Russia-Ukraine problem there. People are just saying somehow, some way, life goes on. These companies are cheap. Let's buy them, okay? But some of that money flowing around the world is, looking for that opportunity. Well, some of that's trickling in our country. And I think this recent bounce recovery in the dollar is actually money flowing into the US, buying US stocks. It may just be US investors who are investing abroad and flipping back to US, but it may actually be global people investing. But I don't think they're investing because of worries over the future like they did in recent years. I think they're saying, I can make a buck in the US because they're the next ones that are going to go up right after Europe. Now, to me, this is great, wonderful news. But then these people that are working on this and have a greater understanding than myself are saying, what this is also doing is causing problems for the Fed because it's helping to hold our economy and may help, the dollar did back off a while there. And between the recent down moving up in the dollar, we might be getting better business for exports. We're improving business around the world on their exports. And they said this could be actually working against the Fed. Whereas there had been worries of the Fed actually hurting the global economy as it fought the war on inflation in the US, which is yet another interesting concept. So this is something we'll have to monitor here in the future in the sense of, I think it's a positive longer term for the US, Europe, if not the world, of that money printing. And China, by the way, is also printing money, just not nearly as aggressive as they had in the past. They come in number 2 behind Japan, and it's kind of a distant number 2. But those people are putting China on the same list with Japan saying, you got to watch those two and their money printing as China tries to rebuild its economy here. What may be the risk if suddenly Japan just suddenly stopped, then suddenly that liquidity may back off around the world. Maybe it backs off here. And if the Fed is pushing harder and harder to fight inflation and they recognize the world's working against them and they got to work harder, suddenly if that opposing force goes away, the Fed may wake up, uh-oh, we went too far. And then you and I may wake up, yay, the stock market's going down and we're heading towards a recession and this and that, So still some confusing ideas within that, but it is something to monitor. And I do believe they're probably on the right track there. I think it is helping support at least the US stock market and a little bit of the dollar right now. But also the dollar is up because it's assuming we got some higher interest rates coming still. But again, even my dollar forecast is saying it can back off a little by April and maybe it can rebound, but I don't see the dollar going higher by huge amounts this year. I think it's in a bear market, but I don't think it's going. I think we've seen most of that bear market. I don't know as the dollar's going quite a bit lower. I think it's probably going to bounce around for quite a while here. And and the actual level of the dollar right now, I think is okay for our exports, and the same thing for globally. But if the dollar explodes by huge amounts and interest rates explode at huge amounts, well, we're at least going to have a short-term problem in the stock market, and renewed worries over, are we going into recession? And I still don't see the recession at all. I realize the short-term rates have run up so fast compared to the long-term rates. They call that an inversion, and it forecasts a recession, but that thing has been wrong in the past 2 years. And most people say it works all the time or eventually, but I'll tell you, there's some people that worked in the Federal Reserve. One of them actually discovered using the 90-day versus the 10-year rate. And he even said, you know something, this just does not have to work every time. So I'm going to need more proof in this if something's wrong to get on board any kind of a recession or serious drop in the stock market. Yet at the same time, I think the rates got to go a little bit higher here, and we got some work to do to back off on that inflation. And I'd like to explain to people, I know the Fed wants 2%, okay? I think it's going to take a long, long time to get 2%. And I think for the rest of this decade, inflation might average 3% or 3.5%. And we may even see a jump in inflation later during the latter half of this decade, where we get a pattern similar to the 1970s. And I know months ago I told you we're not in the 1970s. Well, we got inflation as high as early 1970s. It's backing off almost like it did in 1970s. And I'm forecasting to back off into 2025. But we may see it does bounce again on us something similar in 1970s, but I don't think it's going to be as much. And I just think it's just not going to average as high later. It just won't be that big of a problem. But it is something to watch out for down the road. But right today, I think if we can just be patient here, inflation is going to erode away and eventually rates back off. But see, I don't think the stock market can wait. I don't think it can wait to see, do we get to 2%? It's never worked that way. As inflation walks down, stock market walks higher, and the inflation is walking down. It might be walking slowly, but the stock market is also going slow, you know. But I think we're on the right track.
Right. All right. Let's take a look at one thing that I've been paying close attention to, and right now it's not really expanded past this, but you've got Russia right now doing whatever they can to generate whatever money they can, and they got all kinds of sanctions on them, this, that, and that thing. Right now, Russia and India are trading oil with each other, and Russia's giving India oil, and India's giving them rubles instead of dollars, right? So that's definitely something different out there, and that's when the oil has always been pegged to the U.S. dollar for the past 50 years or whatever. So it's always been that way. You look at the price of oil right now, and where it's at, it's made a pretty decent rebound here over the last couple of weeks. It's gone from down around back in right the first year at about 72-ish dollars. Now we're up to 77 or $78 here on the West Texas crude. You got 82 something over there on the Brent crude. Everything that I've watched and paid attention to has said that we could see $100 oil again in a little bit of no time, and really see some moves there to bring the oil price back up to that $100 range. As you look at energy right now, Rich, do you have any concerns there with that going back to $100, or do you think that this is just kind of some more rhetoric out there that's just trying to drive headlines?
I think it possibly could go back to $100 because I'm actually calling for what I call minor long-term bottom. What that means is every 3 or 4 years stops going down, and it goes up for a year and a half, 2. Next thing you know, it's back down for a year or 2, and it's that kind of pattern. And so it does look like we're going to get a little more demand than supply. Now, seasonally, at least gasoline should work higher in the summer anyway, summer driving season. And that can kind of drag oil higher. Sometimes oil, though, will reject some of that. It doesn't have to be as bullish as the actual gasoline. But I do think looking to summer, we can see heating oil, gasoline, crude oil work higher. My model saying don't get nervous about a recovery to 100, but do get nervous of 110 or higher. So that's what I'll be watching here in terms of oil hurting our economy and perhaps some of our markets like the stock market and stuff. And will it push inflation higher? And right at the moment it's saying, yeah, give it room to about $100. But I don't have a time frame in that. I'm not convinced it actually goes there this summer. I fully understand why some think so. But I could also see this could be a much more drawn out process, kind of boring, and maybe we get to $100 next year. And here's what I'm finding in commodities. I just put out a special report for subscribers, and a little later actually put out a free one on my website. But what I'm looking at is I see some commodities can work higher in the next year, or I see some commodities like the grains can have a crop problem this year and they explode this year, and then it's just downhill for a few years. My problem is I don't know, is it both those years or which year is it? And it's most difficult I've seen in 40 years here of working with these kind of patterns of supply and demand of which is it. And some of that has to actually do with weather. But what I'm thinking is really commodities want to go down into late 2024 to 2025, real estate down. In 2025, we may even get a little bit of a softness in the economy and stock market even. But what I'm seeing is that there's this top that's due this year or next for the grains. For other commodities, it's clearly not this year, it's next year. I'm a little concerned that going to that top isn't going to be like a 6-month or a year and a half bull market. I think it's only going to be 3 months, maybe 6 months. It's just going to be some pop. And I think, therefore, I don't really want to be long-term bullish these commodities. Yet the model's saying, well, you better be bullish until proven otherwise. So we've got some risk points we're showing people. And even today, I did my weekly update in the grains, and I showed some of these commodity indexes that aren't looking good. It should bounce. They're getting cheap, but it's just warning me we might get a bounce, and next thing you know, it's right back down. I think it's just going to be a struggle, and I think I prefer saying, hey, just remember, looking out to 2025, these commodities can be down. Therefore, it'll also help bring inflation down. So I'm a reluctant bull here in crude oil, okay? I don't think it's going up huge amounts. I don't think it's going to hurt us, but I'm on board with them that there can be at least a bounce here. And and I'm setting these kind of rules where if like May and later this year, if some of these commodities like crude oil are lower than a certain month in recent months, then even though we may still get bounces this year and or next, they're just not going to last. They're not going to get the traction. And ultimately, it's going lower into 2025. And I wish I could be more clear about that and be really bulled up and then really bear, but it's like saying, you really ought to be somewhat bearish and just kind of look out for some pops in these commodities. And yes, oil is kind of setting up for one going into summer.
Right on. Anything else, Rich, that you want to make sure we hit on before we close down the podcast?
Let me take a quick look here. M2 is crashing. I don't know, maybe I already mentioned that. That's a money measurement, and it's the lowest in decades, okay? And all it is the Fed is not only raising interest rates, but it's doing quantitative tightening. They're very, very aggressive, and it's scared people. Can they tighten too much? They're pulling money out of the system. So that scares the financial markets. Can it overdo it? And then suddenly the financial markets lose liquidity and we're going down, we're not going up. Yes, that's crashing, but I think we're going to be okay. It is a bizarre statistic there, but we really had to take off some of this excess money. And it still looks like to me there's still going to be enough money in the system to flow, but it is something to think about. Now, people are going to be concerned of the jobs number tomorrow. The JOLTS job come out and said, yes, some companies are pulling back. They're saying, no, we're not going to hire as many as we thought. We're pulling the jobs off the list. But we still have 1.9 jobs for every unemployed person. That's still very good. So again, this is kind of data that's a two-edged sword. On one hand, you'd say it's going to cut us because the Fed ain't going to like that. We got to cut jobs more than that. So they're going to keep raising rates and eventually something breaks. On the other hand, it is coming down and it's actually a sign of a good growing economy. And that's what's confusing here, because we know we have this war and inflation, but businesses are actually still making decent money. And these stocks are worth more than what they are today. It's just the reason the stock market isn't up another 10% is they're just being cautious. They're very convinced they're going up, but they're asking themselves, but it's today to really load up. And that's an issue. Real estate.
That was the next thing I was going to ask you about.
Yeah. Well, I saw a tweet from, I don't know if he's a billionaire fund manager or he's just managing multi-billions in a hedge fund, but I guess he specializes in real estate. He's at a conference down south somewheres. I think it was a global conference actually, but he tweeted to his people and apparently allowed it to go public. And he just said, it's worse than I thought. It's over. The boom is over in real estate. And I look at statistics and yes, some of these indicators, if you look at the S&P Case-Shiller Index, you can look that up online. They have several indexes of how home prices are going. You can see it's rolled over for the first time in a few years. So if you measured that on a short-term basis, it in theory is minus. Prices ought to be cheaper. But overall, though, they're still up for the past few years quite a bit. And I'm seeing other measurements saying, no, it's not negative. They're not cheaper. They're just not going up as fast. They're still actually going up, but it is slowing. One way or the other, I think it's obvious. The writing's on the wall. Eventually, all those statistics are going to be minus. And I think we do see lower home prices by 2025. That'll also help with inflation. But unlike the 2008, 2009 blowout on real estate that caused our stock market collapse and all this stuff, totally different story this time around. We got safety net after safety net there. So I don't see any massive crash in real estate, and it's not going to trickle over and hurt our economy, stock market. It's just time to cool things off and ease back. There's not much evidence there of these prices coming down, but I will say we're seeing the evidence in volume of transactions. Even local brokers now are telling me, hey, I haven't sold anything in 2 months. And I was working 24/7 because business was so hot and I knew I just had to get it. And now there's, some of them saying, well, I haven't even showed anything in a couple of weeks. So it's really in pockets around the U.S. and U.S. in general coming to screeching halt. Locally here, we're still busy. In a few minutes, I'm leaving to show, a $200,000 piece of land. Somebody from the city is going to come out and saying, I need land. I'm going to buy it. That's my long-term investment. But I sense even locally, we're starting to back off. And I'll say the boom is over on real estate. And that will concern some, but really that also helps us fight with inflation. And that's what's so confusing. You hate to hear about negative news, but some of that negative news is actually positive long-term. Yep. And again, I don't see a crash in real estate. It's just time to cool things off here. So.
Right. Sounds like the equipment market. Very much so. Not a crash, just cooling down of prices. Yeah. So on the used equipment side of it. So absolutely same.
I know. I got a friend right down the street here sells used cars, and then he has small new tractors he sells and a variety of other things he sells. But I was concerned he'd get caught up with too many cars with the collapse. He said, boy, these used cars have really come down. But he did the correct thing. The higher they went, he kept less and less inventory, so he didn't buy too far ahead. And so he feels like he'll be all right. And So, and then I think we'll hear more of those kind of stories. We're just adjusting here. I saw some more information on the supply chain that just says really anybody is still talking about a supply chain problem as a negative for the country. They're just lagging, that it's pretty much over. And so now all we need is China to come on board. And I'm hopeful Goldman Sachs is right that they're going to surge in the second quarter. They're already saying it should be better because that's going to trickle through and help the U.S. economy and global economies and do well. I don't think China's really interested in a really robust economy there. They want a safety net. They don't want to overdo it. But I think Goldman Sachs might be on the right track here. And if we can get that rebound, I think we'll find we're going to be all right this year. Good stock market rally, get the inflation down, peak out these rates. But I still see touch and go here and some complications, at least in the June, July, when hopefully the Fed will say, good enough, let's sit still for a while.
Right on. All right, Rich, talk about your podcast a little bit, where people can find that out.
Yes, go to criticalpointpod.com and you'll find stuff about myself and my models, but there are also pages you can click on to find some free videos, audios, the locked up subscriber ones, and there's link pages on any of those to sign up for the premium service. But I have a plan for the rest of this decade. This is how I've done it for many decades. I was right in the 2000s. I was right in the 2010s. I think I'm going to be right in the 2020s here. I have that longer-term type plan, and it's actually working very well. Even we've had all this turbulence and problems. And then I break it into increments so that it's not too long for some people. And I have a plan where we're going this year and next. And then inside of that, I try to give you ideas of how things are zigzagging from month to month, day to day. Even if you don't like investing and trading that fast, it allows you to see how things are flowing. And therefore, it can increase the confidence that when I tell you of a signal that is important enough for you, you'll take it.
Right on. And you right on Twitter, you're what's the best way to get a hold of you? Rich, reach out to you.
Yeah, at Rich_Posson, Posson.
Right on. Okay. Well, Rich, I appreciate you being on the podcast, man. I always learn something when you come on here.
Thank you. I really enjoy this.
Right on, man. I'm Casey Seymour with Moving Iron Podcast. Check me out on Facebook, Twitter, and Instagram at Moving Iron LLC. You can also find me on LinkedIn at Moving Iron Podcast, and also go to the LinkedIn page or the YouTube channel, which is Moving Iron Podcast YouTube, and you can find this video version of this podcast here. So go to Moving Iron LLC for everything Moving Iron related, and get information from Moving Iron Summit coming up here in Nashville, Tennessee, September 11th through the 13th. Got all the information there, and you can find a lot of stuff about speakers and different stuff we have going on there. So with that, I am Casey Seymour with Rich Posson. Smooth Smart folks out.
Moving iron in the 21st century. Hard-working people working hard for you and me. Moving iron, time and time again. Through the years you'll find us here.